You who didn't hear my introduction, my name is Gina Buckles. I'm one of the members on the 401k Plan Professional team, and we're excited you could join us today. Let me first of all introduce you to our team. For those of you who don't know me, again, I'm Gina. I'm one of the advisors here. Kristen Carlin is our marketing director, and I want to thank her for helping put this presentation together with me so quickly. Many of you also know Jessica and Jenna, the other advisors at our office, and Kelly Panic. So again, our team welcomes you, and thank you for taking a little time out of your day to learn about the CARES Act. Just to let you know as well, this is part of a webinar series. We have 8 webinars scheduled in 2020. This actually makes 9. We added this one very quickly. This legislation was enacted just a few weeks ago, so we put it together very quickly. It's one of the best ways we can get information out to a number of employees and clients, so thank you for that. Every webinar we do is recorded, so in about a week or 2, you will receive a recorded link, and you're welcome to share that. And always, I want to encourage you to check out our website at 401k Plan Professionals and our YouTube channel. You can find a great deal of information there. All of our webinars are housed there. There's some great videos. There's one in particular that I know has been very popular on navigating market volatility. So please be sure to check that out as well. So before I get started, I do have just a couple housekeeping things I want to mention. You are all on mute, so I can't hear you. I also can't see you. So if you're in your pajamas or you haven't showered, there is no judgment. But the reason I mention that is the best way to submit questions is through the Q&A feature on the Zoom taskbar. So I will pause at the end of the presentation and take any questions. But as always, if you have plan-specific questions, please reach out to our team. Give us a call, shoot us an email. We've been having a number of conversations. And if it is more plan-specific, we can probably have a more meaningful one-on-one conversation. But as I said, time permitting, I'll try to get to as many questions as I can. So let's talk about the CARES Act. This was part of the $2 trillion stimulus bill that President Trump signed into effect on March 27th. So like I said, just a couple of weeks ago, it's a massive bill that provides a lot of financial aid to individuals, small businesses, and companies. For the purposes of today, we're just going to talk about how it impacts qualified retirement plans and required minimum distributions. So the plan highlights, what we're going to touch on today, are specifically plan withdrawals from qualified retirement plans and the special tax treatment that's being applied to those impacted by the virus. We'll also talk about who is considered impacted by the virus, so who meets the definition of a coronavirus-related distribution. We'll talk about plan loans, both new loans. They've increased the limits for plan loans for a short period of time, and also outstanding loans. So if you have employees or if you are an employee that has an outstanding loan, some relief that's being offered there. Also required minimum distributions. And I'll talk briefly about what plan sponsors need to do now and when the plan amendments will happen. And then lastly, there has been some expanded authority granted to the Department of Labor in case there needs to be further changes. So let's talk about plan withdrawals. So most important thing to know is that this special tax treatment will be applied to any distributions that occur in 2020 and apply to anyone who's been impacted by COVID-19. The most important things you need to know is that those distributions will be exempt from the 10% early withdrawal penalty if you're under age 59 and a half, and it'll also be exempt from the 402F notice requirements. Now, I know a lot of you probably don't know what a 402F notice requirement is. That's okay. That is just simply the special tax notice that accompanies any distribution coming from a qualified retirement plan. So that exempts that notice requirement, and it also exempts the mandatory 20% federal withholding. So let's just review briefly. If someone takes out a cash distribution from a qualified retirement plan, that distribution is subject to a mandatory 20% withholding. They have to get this special tax notice. And if you're under 59 and a half, there's an early withdrawal penalty. So just to be clear, if you are impacted by the coronavirus, that doesn't apply. So it is still a taxable distribution, but you'll notice in bullet point number 4 that the taxes attributable to that distribution can be spread out over a 3-year period. So you can spread out that tax liability in 2020, 2021, and 2022 if you so choose. So you definitely don't have that huge tax burden in one calendar year. The other option to consider too is on these distributions, they are granting people the opportunity to recontribute it, to roll it back into the plan over a period of 3 years. If an individual does that, then whatever they roll back in won't be taxable at all. So those are definitely some important tax changes to distributions from qualified plans. And it does apply to distributions up to a limit of $100,000, and that's in aggregate. So people could take multiple distributions out throughout 2020, and the special tax treatment applies to the aggregate distributions up to $100,000. Now let's talk about who qualifies as someone who's impacted by the coronavirus. The first couple definitions are pretty cut and dry. First of all, if you've been diagnosed, if you have a positive test that's been approved by the CDC, shows you have the coronavirus, then clearly you've been impacted. If you have a spouse or a dependent that has tested positive for the virus, the special tax treatment would also apply to you. The third reason is the most broad. So that means if you have been adversely affected financially by the coronavirus, so that means if you were quarantined, if you were furloughed, if you were laid off, if your hours and pay were reduced because of this pandemic, or if you have to stay home to care for your children and you can't work, or if you're a business owner and you have to close your doors, that would apply as well, or even if you have to reduce your hours in business, that would apply too. So obviously a very broad definition there of who would be impacted and who would qualify for some of the special tax treatment. One important thing I want to make sure is clear is that the onus to prove this falls to the taxpayer. It falls to the person who's taking the distribution. Now, I know we probably have a number of HR directors and plan administrators on the call today, and even though you're on mute, I think I can probably hear a collective sigh of relief, because many of you know that under traditional financial hardship rules, if someone comes to you and wants to take a distribution from their 401k account because of a financial hardship, say medical costs, tuition expenses, avoid foreclosure on your home, they have to provide you with documentation. You need to retain that. That is not true for the virus-related distributions. And I think the spirit of the act was to allow these distributions to happen as quickly as possible and to those most in need. So again, the onus to prove that you were impacted by the coronavirus, it does fall to the taxpayer. And my best advice to anyone who does take a distribution or take advantage of some of the loans that'll be available is just to retain documentation and talk to your accountant. So that'll be important when they file their taxes for 2020. So again, this is not something that plan sponsors and clients need to collect data on. It really falls to the person who's taking the distribution to have proof that they satisfy one of these 3 reasons. So let's talk about plan loans. Plan loans, they are increasing the limit for those people affected by the coronavirus and maybe want to take a loan instead of a distribution. The limits have increased. So the maximum amount of a loan that you can take from a 401k account is $100,000. That's increased from a maximum of $50,000 or 100% of the present value of your account, of your vested account balance. So the lesser of the two, either 100% of your account balance or $100,000. So again, those limits really kind of the same. It's still provides an amortization schedule, there's still loan terms, it's just that the limits are higher. And that is, that'll be effective from the date of the enactment, which was March 27th, for the next 180 days, for the next 6 months, starting from March 27th. So if anybody wants to take out a loan, they were impacted by the virus, they can apply those larger limits, if they so choose. Now let's talk about outstanding plan loans, because I think this is where we're going to get some questions. I think we're going to have employees who are maybe placed on furlough or a leave of absence. They have an outstanding loan. They're not in a financial position to continue to make those loan repayments. And this provides relief for those individuals. They can delay those loan repayments for up to a year. Now, I think what's important to know, I think how this will transpire is, let's say you have an employee, or you are an employee who needs to stop making payments for, a couple months on your 401k loan. When it gets to 2021, the record keepers will re-amortize that loan. Interest does accrue during that time, and the loan still has to be paid off by the maximum duration. So most plan loans have a maximum duration of 5 years if it's a non-residential loan. So the loan would still have to be paid off in that 5-year period. But again, if you need to stop making payments to your loan for a period of time, during this 180-day period, that's fine. The loan will not go into default. It will not become a taxable distribution. And just know that the record keepers will have to re-amortize that in 2021. I do think it's important to note, for those HR directors, plan administrators out there on the call, I think it's important to communicate with your record keeper who has been placed on furlough, especially those who have an outstanding loan, just so the record keeper can track that accurately, and they'll know that if there are loan payments that are missed, that's okay, and the loan won't be placed into default. So good information there on outstanding loans. And let's talk about the required minimum distributions. These are waived for 2020. They're waived for all 401k plans, 403b governmental plans, and IRAs. So this is a true waiver. That means you don't have to make it up. So individuals just do not have to take a minimum distribution this year. And I think the reason for that is if you understand how required minimum distributions are calculated, they're calculated on the balance from January 1st, 2020. So if you can think back to the utopia we lived in on January 1st, 2020, when we didn't even maybe know where Wuhan, China was, and we had no idea what COVID-19 meant, account balances were really high. And that's what the required minimum distribution would have been calculated on. And now, with the market being considerably lower, it just doesn't seem fair to have to take a required minimum distribution. So I think that's one of the reasons that the requirement was waived for this year. It was also waived back in 2009. And one thing that we're not 100% clear on, pretty sure, if you already took your required minimum distribution in 2020, we do feel like you can probably roll that back into the plan and not incur the tax liability on it. That's what they did back in 2009, and I suspect that that'll probably be okay in 2020 as well. We're waiting for a little bit more clarification on that. However, if you already took your 2020 RMD and you are someone who was impacted by the coronavirus, as we talked about earlier on plan withdrawals, you can roll that back in and not incur the tax liability. So still a withdrawal, you could roll that back in and not have to pay the taxes on that RMD. So I think you'll be okay if you've already taken your RMD for 2020. If you haven't, you don't have to, you don't need to. So. And let's talk about, before I talk about the plan amendments, that's pretty cut and dry. That's not going to happen for a couple of years down the road. But let's talk about the different record keepers and how they're scrambling to manage these changes. And I know we have folks on the call who use a variety of different record keepers: Empower, Vanguard, Prudential, Mass Mutual. Hopefully I've probably named one of the record keepers you use. But you probably have already received communication from them. And they're giving plan sponsors the opportunity to opt in or opt out of these provisions. So keep in mind, you don't have to offer these provisions. You don't have to offer these in your plan if you don't want to. I will say, by and large, the clients we've talked to, they are giving their employees the option for some of these special tax treatment on withdrawals and loans that we've talked about. So I do think clients want to give those employees who are suffering the most the opportunity to get some special tax treatment. So by and large, I think that's the consensus that we're hearing. And most record keepers are making this really easy. Like I said, all they want to know today is, are you in, are you out? Let us know. And also, most record keepers, they are ready now, or probably will be by next week, to take those phone calls from employees, from individuals who are impacted by the coronavirus and need to take a distribution or a loan. So that's good to know. I think record keepers have done a great job getting up to speed as quickly as possible. And the other thing I want to mention here too is we certainly, I certainly hope that there's not a lot of people who need to tap into their retirement account. It is still considered, or should be considered, your last resort. You know, it's not a great time to take money out of your retirement account. We don't want folks to lock into these market losses. And we also don't want people to get off track saving for their retirement. But on the same token, we have to be sensitive to the fact that, you know, there are people that this may be the last assets they have to keep a roof over their head or keep food on the table. So that's the spirit of the legislation, to keep people out of poverty and to give them some access to funds. And with regard to your retirement account, it should be the last resort, but it's there if you need it. So it's a little bit on what's going on record keepers and kind of our views. Of course, if you or any of your employees have questions, please have them reach out to us. We can kind of counsel them on the new rules, and we can connect them with the record keeper as well. As far as plan amendments, your plan document does not have to be amended for this until the end of your 2022 plan year. For governmental plans, it's even longer. So that'll be forthcoming down the road. So you'll hear more on that later. But again, most record keepers just want to know, are you going to apply these provisions or not? That's the most important thing today. And lastly, the CARES Act also expanded some authority to the Department of Labor. It gives them the authority, if they want to extend some other deadlines, like contribution deadlines, participant notice deadlines, or Form 5500 deadlines. Right now, those have not been extended, but the Department of Labor has that authority if they so choose. So again, right now, those deadlines have not been extended, but stay tuned. They could be. Again, I just want to encourage everyone to use the resources we have out there on our website, our YouTube channel, and definitely, like I said, reach out to us if you have specific questions that are specific to your plan. We've had a number of calls with our clients, investment committees, individuals. So please just feel free to email us, and we can have a meaningful conversation. There is our website and our YouTube channel. And I just want to thank you for your time today. I hope the information on the CARES Act was helpful. Our next webinar will be next Thursday, same time, same place, virtually, and it'll be on kids and money. So a little lighter topic next week, but I think it'll be fun. I think we've got some good information, especially for those parents who are out there teaching their kids at home. This might be some good tips for you. So I'm just going to pause here for a moment and see if there are any questions from any of our audience members, like I said, just send those through the Q&A feature on the Zoom. Otherwise, we will look to, if you have questions, like I said, don't hesitate to reach out to us. I don't see any questions out there right now, so I'm just going to send my best wishes to everyone on the call. Please stay healthy, the best to you and your families to get through this and get through this together. Actually, I will pause for a moment. It looks like we do have a few questions. So to be clear, we don't collect documentation to prove coronavirus-related hardships. That is correct. The onus falls to the individual who takes the distribution. And again, my advice to those individuals who take a withdrawal or a loan is that they keep documentation. They need to keep documentation, not you as the plan sponsor, not the HR director, but the individual who takes the distribution. I would encourage them to keep documentation and talk to their accountant. But you are correct. So I'm just going to answer that real quick. And then I've got one other question here. Can we wait to decide on whether to opt in or opt out? I would, yes, you can wait, and you know it's not terribly urgent. I think the only sense of urgency is if you have an employee who wants to take a distribution because they were impacted by the virus. Your record keeper would need to know where you stand before they process that distribution or that loan. So you know it's not imminent that you make a decision today, but I would say reach out to our team. We can have a conversation with you and help you come to a decision. But I would probably say try to make a decision relatively soon, just in case you have an employee who may need to utilize this. At least we'll be able to answer their questions for them. So not a huge rush to do that. But again, reach out to us. We'll talk to you or any committee as well. So thank you. Let me see if there's any other questions out there. I think I got those questions answered. Again, wish everyone good health, and hopefully we'll get through this together. So thank you so much for joining our call. We look forward to having you on our call next Thursday too. So thank you. Bye-bye.